Hello, I am Virgili, as usual. Even after 6 years, my beloved computer cannot pronounce my name correctly. This paper was part of my PhD thesis researching the impact of the crises on the efficiency of the financial market. Hope you enjoy the narrative by my computer. I will begin by introducing myself and my research. I will give a brief introduction of the paper and the crises. Next, I will explain the theory underpinning this paper in my area of research, behavioral finance, in particular the overreaction/underreaction hypothesis. Then I will introduce and briefly discuss the underlying model of this paper, the Markov regime switching arch model. Logically, the next steps will be the model specification and data description. Following on will be the empirical evidence. Finally, the conclusions of the paper. A key criticism of the efficient market hypothesis is that it does not reflect the real world of the financial market. As noted by Virgili and Richter 2015, market participants are Homo sapiens and not Homo economics. In other words, as elegantly put by Bernard Baruch, what is important in market fluctuations are not the events themselves, but the human reaction to those events. Hence, there is a need to understand the psychological states of the market participants during these events, hinting at the use of behavioral finance. In recent studies by Virgili and Richter 2015 and Virgili et al. 2016, they both found the price could be affected by overreaction and underreaction during the crisis. This led to the price deviating from the fundamental value for sustained periods of time during the crisis. There are two key elements of behavioral finance which can be explained through the use of a Markov switching arch/GARC model. In research by Blanchard and Watson 1982 and Branch and Evans 2011, it was discovered that bubbles can sometimes periodically collapse. Furthermore, as hinted by Virgili and Richter 2015 and Virgili et al. 2016, the changing market environment can affect the market participants. These two key factors can be explained by the Markov switching arch model. Therefore, we use Mackay 1994 model to explain the impact of the changing environment on the reaction during the period before and after the recent financial and sovereign debt crises. The last few years have been a perfect storm of crises and economic downturns. The financial crisis of the late 2000s triggered a chain reaction terminating in the sovereign debt crisis. In many countries, the economic downturn that followed the financial crisis was the longest and deepest since the Great Depression of the 1930s. This downturn and the sovereign debt crisis in the Eurozone has signaled a deep question: can monetary unification be achievable without fiscal unification? However, here we are only interested in the market participants' reaction to these events. Hence, we will not go into great details about these events, but there are many articles written about them. Here are some. Perhaps the biggest issue concerning this article is some of the large financial organizations affected by the financial crisis are the exact market participants which the global financial market depends upon. Here are some of the biggest financial crises of the last 25 years. Note that most of the crises are local to the area or country to which they are based. However, the recent global financial and sovereign debt crises are unique in that the impact from them is truly global. This means that many market participants were limited in their choice of assets and markets, which points to the reason why there was limited negative impact on the US and German sovereign debt markets. According to the literature on behavioral finance theory, there are two influencing factors which could cause the market to deviate from the fundamental price. The first factor is the sentiment of the market participants on the information. The market participants could have different perspectives on the information. They could also react heavily or lightly to the information. Finally, they could implement different strategies. A good example is long-term versus short-term. The second factor is the state of the market or information at the time may have an impact on the market participants. In general, market participants react differently to a bear market versus a bull market, good news versus bad news, whether the information is public or private, and how big the economy or capitalization underpinning the asset is. The Markov switching model was originally proposed by Hamilton 1989 as a discrete state model to illustrate the regime changes in non-stationary datasets in macroeconomics. However, It has long been acknowledged that financial markets sometimes go through alternate high/low volatility periods, as noted by Hamilton and Sismell 1994 and Kite 1994. This led to two different extensions of the Markov switching model by Kite 1994 and Hamilton and Sismell 1994. Both SWARCH models integrated the Arch model of Engel 1982 and Markov switching model of Hamilton 1989. The difference is that Kite 1994 allows the intercept of the Arch model to shift, while Hamilton and Sismell 1994 allow the scale of the conditional variance to shift. There is a lack of evidence in the literature for regime shifts during the recent financial and sovereign debt crisis. Two such articles are Christensen 2008 using the Chi-SWARCH model and Abdurahmanov 2013 using the Hamilton and Sismell variant of the SWARCH model. Originally the idea was to implement a switching GARC model, however the sheer complexity and exaggerated high persistence in the volatility associated with such models meant we had to use the SWARCH model instead. Conversely, estimation issues raised by the Hamilton and Sismell variant of the SWARCH also limited our choice to the Chi variant. As noted earlier, the model is a combination of the arch of volatility proposed by Engel 1982, as illustrated by equation 1, and the Markov switching model of Hamilton 1989 in equation 2. This combination results in the Chi 1994 SWARCH model in equation 3. Remember, the Chi model allows the intercept to shift according to the regime. As illustrated by the slide, we use the end-of-day bid prices on 6 sovereign debt markets obtained from Bloomberg. With the exception of the Greek market for obvious reasons, we use 2 10-year government bonds issued in 2002 and 2007 mainly due to the maturity effect. The size of the datasets is uniform to 2,480 and 1,500 observations, with any missing data being filled by the previous known price. Due to the stationarity requirement of the Arch model, we differentiate the price to the first order. In estimating the SWARCH model, we use a combination of these options, a normal distribution with the maximum likelihood and BHHH method. However, errors in the US and German 2017 datasets meant that we had to use the BHGS method. Estimation errors continue to play a major role, hence, as will be illustrated later, we were forced to reduce some of the datasets. In essence, the 2012 bonds were associated with the period of changing market environment in the global financial market. Of course, the later stages of the period were associated with the financial and sovereign debt crisis, yet it was also governed by a number of events which changed the market environment during the early stages, such as the asset price bubble and the accountancy issues leading to the bankruptcy of Enron and WorldCom. However, 2 events, which had an influential impact during the early stages, were the introduction of the euro and the terrorist attacks of the 11th of September 2001, leading to a number of wars. Although these 2 events occurred before the observed period, yet the persistency in their aftermath had a big impact on the behavior of market participants. The evidence from figures 1 to 6 certainly points towards the existence of a regime switching behavior influencing the pattern of price volatility in the sovereign debt market. While the figures illustrate the extent to which the sovereign debt market in general is highly volatile within the 2012 bonds, further illustrated by analyzing the probabilities of the high volatility regime in Table 1, in essence Regime 2. Surprisingly for our observed markets, this is highly significant, with a minimum probability of 0.8637 as observed by the Greek market, backed by the probability for the low volatility regime, which is Regime 1. With a maximum probability of 0.0209 for the Portuguese market. This would suggest it is more likely that the next regime will be highly volatile. With the exception of the Greek and Portuguese markets, the probabilities are in the high 0.9, which are hinting at the other observed markets being more volatile. Notably, the Greek and Portuguese markets also point to a significant probability of a high volatility regime. The US and German markets seem to be portraying a more volatile market than the other observed markets. However, as illustrated by figures 1 and 2, at the highest level their volatility levels are below the Greek and Portuguese markets. A counter-argument is during some spells the level of volatility for the German and especially the US markets seem to be higher than the Greek and Portuguese markets. A possible explanation is the quality and liquidity factors of the US and German markets, making them the benchmark markets for both the dollar and euro currencies. This makes them prime markets for flights to safety during crises or extreme events, that is, niche and uncertainty. Another influencing factor with respect to both markets is that the Basel II regulations to hold sovereign debt on their balance sheets as capital are a requirement of many financial institutions. Hence, many of these organizations choose to hold either US or German sovereign debt depending on their home currency. The arch intercepts in both regimes for the Italian and Spanish markets seem to be hinting at very low levels of volatility. This is understandable as the high volatility did not impact until the later stages of the crises, as illustrated by figures 3 and 4. Both these figures also illustrate that the highly volatile period of the early 2000s did not really influence the volatility levels. An influencing factor is that the early stages of the crises did not affect either the Italian or the Spanish markets. Arguably, the financial crisis did not affect the Spanish market until later on, and the Italian market remained unaffected. The Greek and to a lesser extent Portuguese markets were in the eye of the hurricane during the sovereign debt crisis, hence the higher levels of volatility, as illustrated by figures 5 and 6, which had an impact on the regime 2 arch intercepts. However, as the figures also illustrates, there are long periods of low volatility in both the Greek and Portuguese markets. An influencing factor is that both these markets are not liquid and, more importantly, are not large markets. Hence, as illustrated by the figures, during "normal" market environment, these markets do not have a high number of transactions, which gives the appearance of stable markets. In essence, the 2017 bonds are associated with a highly volatile period in the global financial market, mainly due to the financial and ensuing sovereign debt crisis. Although this in itself is interesting, mainly due to the differing impact on the observed markets of each crisis. However, as hinted previously, another influencing factor is the different impact from the on-the-run and maturity effects on the financial and sovereign debt crisis respectively. The final factor is the extended observed period, therefore, allowing us to analyze the full impact of the sovereign debt crisis. These factors may have had an effect on the SWARCH model. The evidence from Table 2 is pointing at a mixed picture with respect to the probabilities. The high probability of regime 2 suggests that there is a significant probability of a highly volatile regime throughout our observed markets. With the exception of the Portuguese market, the observed markets are hinting at a significant probability of above 0.9 that the next regime is highly volatile. With the US and German markets approaching 1.0, this seemed to be indicating that the US and German markets were highly volatile throughout the observed period, although the probabilities of both the Italian and Spanish markets were also significantly high. In the next 3 slides, we will expand on the results. Like the probabilities, the arch intercept for regimes 1 and 2 points at a rather mixed picture in terms of the level of volatility in the observed markets. As illustrated by figures 7 to 11, it would seem that the German market had the lowest level of volatility in both regimes. An influencing factor is that both crises did not really affect the German economy or financial market, despite the downgrade of the German sovereign debt ratings. However, the evidence from Figure 8 seems to suggest that the market was highly volatile and backed by the probability of regime 2 as hinted earlier. A possible explanation is due to the status of the German market as the benchmark market for the Eurozone. Hence, the persistency of the high volatility regime is the result of flights to safety during both crises. Similarly, the persistency of the high volatility regime during the early stages of the US market observations was the result of a flight from the financial assets to the US market during the financial crisis. Since the financial crisis had its origin in the US, hence, these flights to safety as illustrated by Figure 7 significantly affected the US market. However, the timings of the 2 hikes in volatility during the sovereign debt crisis period seem to be hinting at the Eurozone sovereign debt crisis. Hence, a plausible explanation is that the US market was at the center of a flight from the euro to the US dollar. It must be remembered that due to problems with the estimation of the SWARCH model, We had to limit our observed dataset to the 1st of October 2012, which meant the full impact of the US fiscal cliff and debt ceiling crises on the US market was not captured. To a certain extent, figures 9 to 11 seem to be hinting at the limited impact of the financial crisis on the IPS markets. Although there is some evidence of high volatility regimes during the financial crisis, yet this evidence seems to be telling. Certainly, the evidence seems to be pointing at jumps rather than changes in the volatility regime affecting the markets during the financial crisis, especially around the period of the Lehman Brothers bankruptcy. This seems to be hinting at a period of reactive behavior by the market participants to events during the financial crisis. However, during the sovereign debt crisis, the regime changes became increasingly persistent and frequent. An interesting factor is the lag between the Greek deficit revision and the reaction of the market participants, leading to the contagion in the IPS markets. In summarizing, the SWARCH model seems to point to a regime-switching behavior in the price volatility of the sovereign debt market. In general, the high volatility regime in both the 2012 and 2017 bonds governed the SWARCH model. The SWARCH model also seems to highlight an interesting factor in the 2012 bonds. The observed markets seem to be generally divided into three groups depending on the pattern of the volatility and regimes: the US and German markets, Greek and Portuguese markets, and Italian and Spanish markets. Another factor observed in the patterns of volatility in the 2017 bonds is that IPS markets do follow a similar pattern of volatility, while the US and German markets seem to be dictated by individual pattern of volatility. A key factor in our research is that the SWARCH model seems to be identifying the changing environment for each of the observed markets, since each of the markets was affected by a number of different factors. In concluding, the evidence does hint at the changing environment affecting the market participants' reactions. This indicates there seemed to be an overreaction/underreaction during both crises in the sovereign debt market. However, there was an underreaction during the pre-crisis asset bubble and to a certain extent the financial crisis, since the macroeconomic indicators were indicating the worsening underlying economic condition in the observed markets. A big issue is that market participants also react to policymakers. The problem is that during both crises the policymakers were also reacting to events. At the heart of both crises there was confusion brought on by mixed political communications. These two issues illustrate a genuine lack of ideas and agreement by the policymakers, leading to an overreaction. Another issue is the existence of incomplete and/or asymmetrical information during both crises, which led to misunderstandings and divisions among the market participants. The sad thing was that the spillover effect that followed the initial stages during the crises was partly a consequence of the overreaction to the indecision of the policymakers. Thank you for listening to my presentation. Hope you like it. Now I would like to answer any questions you may have concerning this presentation.